Hello, everybody. It is macro trends time. Is that what we call it? Yeah, that's what we call it, macro trends. And it is August 11th. A lot of interesting charts in the world. And I thought I'd start with the 10-year Treasury yield, government bond yield. And I wanted to point out this line. And I'm going to make it even bigger for you. Right? Just a shade over 3% on the 10-year Treasury yield. Way back here, just after the dot-com crash, it got down to a little over 3, stayed above, did the jitterbug around it, including a crash during the financial crisis, jitterbug, and then another big correction and more QE. And they jump-started growth a bit, rates started to go up, couldn't get over the hump, fell again, got up to here, couldn't get over the hump, fell again, right? It was falling before COVID. Now we're back up to that 3, and it can't get over the hump again. So what is it with this 3-ish% line, 3.1% about? What is it with it? Why can't interest rates get above about 3%? Could it be slow growth forever? Do the bond markets know that I'm right? I think they do. And I think when I show you some other charts, you're going to start to realize that this great divergence that I've been talking about, where most of the capital flows into fourth industrial revolution technology and companies that use that technology well, and then anything sustainability driven are going to be where the big money goes. And we have seen sign after sign after sign of this, chart after chart after chart, indicator after indicator after indicator, and above all, money flow. We know that the big money is going into these things that I've been talking about. And we know that other parts of the market are losing money. We know that fossil fuels is losing money and has been for several years. We know that consumer staples have been losing money. Ask Warren Buffett about his experience with Kraft. Take a look at Procter & Gamble. And if it wasn't for an activist investor coming in there and righting the boat, righting the ship, we wouldn't have had that pop. And now Procter & Gamble probably goes sideways forever. The utilities have been chopping, range bound like they normally are. Financial institutions, the banks in particular, the big banks in particular, you really only want to buy them off of a crash because even now they're not outperforming. All the money is going towards sustainability, decarbonization by another name, and fourth industrial revolution technology, a lot of which are in small cap and mid cap company. So when we take a look at the Treasury yield on the 10-year, fighting to get above 3%, historically, the rate was about 5%, sometimes higher, when we had to kill inflation a long time ago. But 5%'s been pretty historically about normal. Why can't we get above 3%? And it's because big parts of the economy are never going to grow again. And people fight this, and the smart money just invests, and they look 5 years and 10 years out because they're rich. They don't care what happens this year. They buy cheap today and they sell more expensive in a decade or get a step up in cost basis when they die. That's all they care about. I was talking about estate planning about a guy that we know is worth 9 figures today. Me and my real estate agent. There's no reason for him to sell tens of millions of dollars of highly appreciated real estate because when he dies, he's like 68 right now, so that won't be for a long time. His one and only daughter, who I believe has 2 kids, they inherit that money with a step up in basis. And even though it appreciated 5, 6, 7, 800, whatever percent it's been over the last couple of decades, they'll never pay taxes on that. As I go to develop real estate, I'm running into hunks of land where we have to wait for somebody to die. And the place that I'm looking at getting involved with, I can buy one piece of land. I can actually get it on a lease with an option because he wants a higher price. And I'm willing to pay that higher price. I just need a few years to get there, and then we both win. And I know that the property on one side of him is not going to get developed until the person who owns it dies, because he won't sell it before then because he doesn't care. He's already rich, super rich, another 9-figure guy. And we're just waiting for that step up in basis. And then his daughter will probably sell it, have it developed because she'll get to do it with no taxes, and she'll reposition the money into some other new asset. Why does this all matter when it comes to treasuries? It matters because there is a massive shift in wealth going on in this country from older to younger, and it takes a very long time to happen. Because if you're rich and own a lot of stuff, you're probably not going to sell it because you don't want to trigger the taxation, knowing that when you die, your kids get it basically tax-free anyway. Still have to pay the estate taxes, but there's trust and life insurance for that. If you can get out of a 20% capital gains tax just by dying, you don't need the money now, and it's a good enough asset that you can hold on to it. Why wouldn't you just hold on to it? So that slows down growth. Then you have all the other demographics related issues that slows down growth. And you have all the countries of the world on aggregate anyway, not all of them, but most of them are net debtors. In the developed world, with a handful of exceptions, most countries have already spent their grandchildren's money and their great-grandchildren's money. So you end up asking yourself, how do we get out of this? And the answer is you split the economy into two pieces, a growing piece and a not growing piece. You put all the new money into the growing piece, and by attrition and death, over a very long period of time, the non-growing piece drops in price, probably slowly for a long time, and eventually there'll be an event, it'll fall off a cliff, and it'll never recover. So if you are a fossil fuels investor or a consumer staples investor, bank investor, traditional banks, a lot of utilities are going to face this as energy systems get decentralized and don't rely on the utilities proper anymore, as healthcare gets decentralized, as Medicare for all or systems like Medicare for all take over the planet, which is what's happening with the exception of this country. And we have something that's semi-close in Obamacare, which is where most small business people get their health insurance. You start to say, where is the money going to come out of? And where is it going to go? And the mechanism for where it goes is 2 or 3 steps removed from each other, right? It's what do you call that? Kevin Bacon's. It's 2 or 3 Kevin Bacon's removed. So the money doesn't go directly from the shrinking sectors to the growing sectors. It flows through the economy in different ways, through inheritance, through the higher wages that younger, more technically driven people are earning, through the healthcare system. There is a flow of money from one place to the other, and it's not a straight line, but it gets there. And as the money from the old economy trickles into the new economy and the super wealthy reposition over time, it doesn't all happen in a day, we see certain shifts occur. So while the 10-year Treasury can't quite bust into the above 3.1 or 3.2 range, it did go up in the last week, 2 weeks. And the 20-year ETF, which would be kind of a mirror image, indeed fell. So interest rate rose, bond prices fell. That makes sense. Interest rates rose, but the dollar fell. Why would the dollar fall if interest rates fell? What that means is that the bond market thinks interest rates should go higher to fight inflation, but the Forex guys think it's not going up enough. Therefore, the dollar falls. So either the bond people are wrong, or the Forex people are wrong, or they're both wrong. And I'm going to bet that they're both wrong. Although the dollar has gotten into my long-term higher trading range, and I do expect it to come down a little bit over the next couple of years, hence my target for a couple years out over here. The reality is that as we have this great divergence, as the world becomes a little bit less global, right, we trade just a little bit less with each other. And again, if we avoid war and supply chains move to America, as they're doing, what ends up happening is that it is in the United States' best interest to run a more balanced budget. It doesn't have to be balanced. You can still run a 1 to 3% deficit with no sweat because of population growth, which will eventually come more from immigration than babies, which is fine, right? We should be proud of being a nation of immigrants. The dollar drifts into a higher trading range and stays there because of all the advantages that the American economy has, starting with the geography of being probably the best in the world, and ending with rule of law and technology and accumulated wealth. And the fact that at some point, as I've said over and over again, things that make sense eventually happen. It doesn't make a lot of sense for us to fight all the time with China. It just doesn't make sense. It's okay if their economy becomes bigger. You know why? Because on a per capita basis, they won't catch the United States in 4 generations, if they ever do, because they don't have the geographic advantage that we have. They have to buy a lot of things that we get for cheap because they're here. They have to go to Africa and South America and all over the world, Indonesia, Malaysia. They have to go everywhere, Australia, and pay for the stuff they don't have. Whereas we just go dig a hole and get some of what we need or grow what we need. So the United States economy is so remarkably strong compared to every other economy in the world because of our natural gifts, stuff that we don't even control, that's going to be impossible in this century for another large economy to gain an advantage on us. So in that framework, if we simply super slowly pay off our debt over 30 to 50 years, which is what it looks like is going to happen, because tax receipts based on even the current tax code would pull it off. And with very minor tweaks, so we got rid of carried interest. We just adopted the 15% minimum corporate tax rather than the jerry-rigged one that we just did, right? Without raising income taxes, without raising capital gains taxes, maybe some tweaks on how long you hold stuff. With almost no dramatic changes to tax policy going forward. The United States is in a position, even with people aging, it's just impossible in my mind that unless we screw up real bad, the dollar ever ends up down here again, like it did during the financial crisis, and that President Trump tried to do, because he overtly said, I want to drive the dollar down. And he tried. Both times he got it down to here, it bounced back up. And I told you when President Biden was elected that the dollar would get stronger. The bottom of the range for the dollar is probably around here. Bad things would have to happen, self-imposed, for it to go lower. And you can listen to the chest thumpers and everybody else if you want to. You can listen to some of the inflationistas. I subscribe to this. I have a discount code if you want it. It's still like $1,000 a year. It's not worth it in my opinion. It was worth $99 or $199 when I got it. It's not worth $1,000. They're so wrong about so many things so often. These inflationistas, they don't even understand the right questions to ask. Over here for $2,500, and I know this guy, FS Insight, Tom Lee, Fundstrat. I mean, I could go work for these guys probably if they'd have me. I think they would, because we're on the same page on a lot of things. I'm just, 1/3 the price. I read theirs. I'm pretty sure at least one of them reads mine. You become a buy-side analyst and you analyze everybody else's analysis and you say, okay, this guy's right, this guy's wrong. Sell side is you do from the bottom up, like I have done on quite a few stocks for you, and say, okay, this is why this company is going to do that. I don't care what anybody else said. This is what I'm saying. So sell side is original research and buy side is analysis of other people's research. It's the easy way to understand it. Buy side, sell side. And I do both. And the reason I have to do some buy side for stocks is because you just run out of time. Sell side analysis takes a long time if you're doing it right. So when Warren Buffett says, look, 12 good ideas in a year is a lot, think that through. So I've given you about 50 good ideas in the past year, and you're starting to benefit from a lot of them because of this. Remember in the spring when I told you that the small caps were going to start to outperform? Okay. Started telling you that in the second quarter. So going back to March, we take a look at the orange line is SPY, QQQ is teal, and technology is the gold. And what did I say about technology? Technology is still king. It's on the right side of the great divergence. And then what happens over time? Same thing that always happens over time. Suddenly, the small caps are outperforming, and technology is outperforming. QQQ was still getting beat up, but what has happened? The more time goes by, who ends up on the bottom? SPY once again ends up on the bottom. Small caps outperforming even more. Technology, QQQ catches up. Start our timeline in June. SPY again, wrong side of the great divergence. If you look at the charts over really long periods, IWM was trailing if you look at the 5-year, but look at SPY. Now go back and hit all. Let's go back even further. Let's go all the way back to the start of the century. IWM outperforms. And if you pick out a good basket of at least a dozen and up to 20 small caps, you get enough diversification, you can outperform by way more than this outperformance. So long-term, IWM wins. There was an intermediate term period where they trailed. Now all of a sudden in the short term, you're starting to see a turnaround. I tried to write an article for Seeking Alpha a few months ago. I'll show it to you. I'll tell you what, I'm still irritated about it. A generational opportunity to buy small cap stocks. June 20th was the last time I opened it, but I wrote it a few weeks before that. So basically, around Memorial Day, I wrote this article. Generational opportunity to buy small cap stocks. Let's see here. June, July, August. 3 months. Look what happened. They didn't like the article because they thought it was a little too aggressive. So you probably should follow me on Substack, because a little bit more of my content is going to find its way there. We'll see how that goes. You always get it through my subscription because they can't manage my subscription. In any case, small caps have started to outperform. And we are at the very, very early stage of that, because over 5 years, they underperformed. It was actually a little longer than that. It was about 10 years. But over the very long term, they outperform. So if we are just at the start of small and mid caps outperforming, what does that tell you? Well, one of the things it should tell you is that there's a lot of money flowing into them. And a lot of that money is institutions and the super wealthy. The small caps were going to become mid caps. The mid caps were going to become large caps. And those new large caps are going to boot all sorts of companies out of the S&P 500, the zombies that I keep telling you about. And by the end of the decade, between 100 and 200 companies are going to get booted out of the S&P 500, which I'm going to bet on closer to 200. But around 100 is actually normal for any decade. It's true. Around 100 companies get booted out of the S&P 500 every decade. Any rolling decade, 20 to 30% get replaced. I think it's going to be closer to 40% this decade because there's so many companies in the S&P 500 that are high debt and low growth that eventually those two things smash into each other and there's a problem and they have to recapitalize. And the revenues become the arbiter of what the new market caps will be. So when you saw all those oil companies drop down to $1, $2, $3, $4, $5, $6, $7 billion in market cap from 20, 30, 40, and now they're halfway back up to their highs on market cap. Stock prices are higher in many cases, but the market caps aren't. That is a harbinger of things to come for not only the oil sector again at some point, 5, 6, 7, 8 years out probably, as EVs continue to penetrate. By the way, Ford announced 2 million EVs next year. That's what they'll produce. And the F-150s are already sold out. I did actually drive in a Ford Mustang Mach-E this week. Tell you what, that car is so smooth and has a neat feature. If you want ambient noise, if you want engine noise, you can actually press a button and it gives you it gives you the sound that you don't get because electric vehicles are basically silent. So it was kind of neat. In any case, you need to be in the small caps. You need to be in the mid caps. And if you're not, you are missing what I believe is a generational opportunity to double, triple, quadruple your money, possibly by 2025, but for sure by later in the decade. Some large caps will come back to you like, Warner and whatnot. And you just have to understand value, and those actual equations aren't that hard. And then any upside is any outperformance they have in execution. So you can buy some stocks like AT&T and Warner Brothers Discovery super cheap right now. They're going to rise just because they're undervalued. And if they have any catalyst, and if it's a company I'm in, they have a couple that leads to greater execution, better execution, more revenues, then not only do you get the return to fair value, but the line on fair value moves up. All right, so I have Shooter here today, and I just want to go through not so much the S&P 500 chart, but his weekly chart on QQQ. So are you there, Mr. Shooter?
I sure am.
All right. So tell us what we should be thinking this chart on QQQ. And I asked you about the alternate count where we have a ending diagonal in the Elliott wave parlance, which is basically a choppy but downward market for a while. So what are the two ways that you could see this manifesting?
Well, one, it could manifest as it looks now and actually continue up to our 5 up there around 440. Right. However, one thing about an ending diagonal is quite often they happen in the C on a corrective leg. So if you flip back to the center of the chart there from where the ABC is, and that where our 3 target now is at, target 1 right there, an ending diagonal would be about another 25% of that move higher. So it would be just under the B in that move. So it would be a much broader pattern. Now, if you drew a speed line from the all-time high there and, drew that top line and then drew a speed line on the bottom of that, you'd find that it's a broadening pattern. So it just gets a little broader and continues to expand. So that would mean that it's a little more aggressive, as you get the drawdowns. If you'll notice the slope from the first decline to the second decline, notice how it increased. So, the third coming off of that target 1, if that actually is hit and it fails right there, we should have a pretty aggressive pull down. Right. And it should be about 25% steeper than the second move.
So Shooter was nice enough to answer a question for me in the chat today. I asked him, what would an ending diagonal look like? And he popped it up here for me. Let's see, that's a different company. You want this one?
Yep.
So if we get up to this area, it could turn back down, go all the way back down here, bounce back up, and then come back down. That would be a classic ending diagonal pattern.
Correct.
And I believe that's probably what's going to happen. I think that it's not a for sure thing. We definitely could rally to the new high. If we do, I think the question we have to ask is how real is that? And in a great divergence world where technology and small and mid caps all perform, then where you'd really be losing on relative performance is if you were highly correlated to the S&P 500, which has all the zombies in it. And that's why I tell people never invest in the S&P 500. I mean, to me, when I think things are going up, I want to bet on QQQ. And when I think things are going down, I want to bet against SPY, because QQQ is the better upside index and SPY is the weaker index. So when things are negative, I want to bet on the weaker index falling more. Now, we don't know, and FS Insights is saying the same thing. We don't know if this is going to break out, or we don't know if it's going to get rejected. And we won't know until we know. I'm going to give you a thesis. I think it gets rejected by about the first week of September, going into the next Fed meeting, because I don't think the Fed is going to back off of interest rates just yet. I wondered if it would be September, but with the way they structured the balance sheet runoff, I don't think so. They would have waited to have the balance sheet runoff be higher than it is now, past September 1st, if that was even in play, that they would pause in September. So I don't think they're going to pause in September. I think it's still going to be a 0.5 point increase. It could be 0.75 point if we get another hot number on inflation. And I think that the pressure of higher interest rates and the bond guys being wrong and the Forex guys both being wrong, the dollar goes higher, and that puts pressure on not only U.S. securities, but especially global securities, especially international securities, which is why, we've started to scale in the EMQQ at 30, because we know that the Asian nations are easing already. So if this plays out the way I think it's going to play out, then we get a couple more opportunities to buy into the market. And one thing that Shooter said just a minute ago, he talked about that broadening pattern. Remember, I've talked to you about broadening patterns before, right? The megaphone pattern. Those are usually very classically a way of saying the small guys are betting against the big guys. And what do we know about those bets? How often do the small guys bet right and the big guys bet wrong? Almost zero. The small guys never beat the big guys for more than just a little while. Maybe in the short term, they get something. Well, they get their rally, they get their shorts, whatever it is. But in the long run, and actually even the intermediate run, any time period over a year, the big guys always win. The small guys never win for more than months at a time. So even if this does rally up to here, this 440 area, right? 440 is what you were talking about, Shooter?
Yeah.
Even if it rallies up here, that would be, to me, a monumental selling opportunity. In here, I'm not doing much. People have asked me about, should I sell covered calls or trim some of these stocks that have doubled in the last couple of months? And the answer is no. My small cap and mid cap stocks are all potential 10 baggers, every single one of them. Now, will they all do it? No. Will some of them? Yes. And you will make the most money in your career letting your winners run. So how do you manage your asset allocation and your cash balances? It's by selling cash secured puts at these low points. Like, I had a list of 20 or 30 cash secured puts over the last, 1 to 2 months ago. And as these prices went up, those cash secured puts get way out of the money. You can close them, or since most of them were September, October, you just let them expire. And now all of a sudden, you've added cash to your asset allocation. So I sell cash secured puts at what I think are short-term bottoms, let the market rally, the puts expire worthless, I have cash again. I never have to sell my winners. And the reason you never sell your winners, in my opinion, now if they get to be a huge percentage of your asset allocation, it would change your life somehow if they drop temporarily. You can trim a little bit. You pull back your asset allocation from something that's grown to 8, 10, 12% back to 8 or back to 6, right? But winners are winners, and you want to be in your winners for a very long time, because some of them are going to hit that hockey stick and go up 3, 4, 5, 600% in a year or two. And I think we have at least a dozen of those in this basket so far. I look at our basket, and I look at the satellite stocks, and I look at some of the AI stocks, right? All these fourth industrial revolution things. And I look at some of the streaming stocks, one streaming stock in particular I've mentioned already, Warner Brothers Discovery. And I think it's so grotesquely undervalued, even that could be a 10 bagger. I don't think it will be, but it could be. It's got that potential. if all the execution goes right. But I think it's a triple all day long from where I started to buy it, which was quite a bit higher in the 20s. So I think that's a stock that, gets to 60-ish. It's 14 or 15 now, and it might get up to 200. So when I take a look at stocks individually, I don't want to sell those because because that first tiny move up. But when they drift down, I'll sell that cash secured put, take the income, because I got almost no risk. Because if I get it at a super low price, and I say I have almost no risk because, I'm right 4 out of 5 times on the future of these companies, not precisely, right? I don't know exactly where they're going. But if I say a stock is going to be a winner over the next 5 years, my career, 4 out of 5 times, they've been a winner. Trend is your friend. Just like people who tell me I'm lucky at poker. I've been winning for 35 years. Yeah, I think probably there's something to my poker game. So when my stocks get down to here, presuming something hasn't gone horribly wrong like on track, right? I acknowledge my losers. I'll sell the put. Stock will go back up. Put will expire. And now I have cash again. Stock market comes back down. I sell another put or I buy something. And if we get this ending diagonal, and this says July 2023, here's what I think could happen. I think this could all be compacted between now and December. It'd be really crazy markets for that to happen. So if it goes to around here, to around here, around here, around here, I'm saying that could all happen by December. You've heard the date that I've given you. I believe at this point that the Fed pause is either October or December. I think probably December makes more sense because there just isn't any way for them to raise rates too high or it will kill supply chains from moving and getting filled. They have to leave rates low or they kill the supply side, and they can't do that. All they have to do is beat OPEC, and that's going to be through different mechanisms. The Fed can't beat OPEC, but President Biden's been beating them, right? Price of oil's come down a lot, and it might drift back up. But the narrative, the trader narrative out there, and I heard the Goldman Sachs guy say it today, one of their junior dudes, he said, well, you need higher prices in oil. And I talk about oil a lot because it's been that big of a deal on the economy for my whole life. And it still is now, but we can see the light at the end of the tunnel. And it's a train about to run over oil, like I said, middle of the decade to late decade. So if we can get through this price controlled period with OPEC by drilling an extra 1 million barrels here, by strategically using the Strategic Petroleum Reserve, it's even in the name, and you then get 600,000 more barrels from Canada, which they've promised us by next year. And then the panic pumping starts from oil producing nations, or Iran comes online because they actually signed the deal, the nuclear deal. Oil just doesn't have a lot left. And trying to game that last year or 2 or 3, I think is hugely dangerous, especially with what we know about battery technology. I mean, literally likely to improve 20 to 30% by next year and improve incrementally by about 90% by the end of the decade. Batteries are getting so good so fast that that's going to scare the hell out of OPEC and all the other oil producers. There is another cliff coming for oil. I don't think it'll stay super low, super long, right? Because low prices are the cure for low prices, just like the cure for high prices is high prices. But between now and the end of the year, and hopefully not into next year, but I mean, this could happen. We're going to get some opportunities to sell puts low. And for you to get a redo at least once, because it might, if it does go up here and come back down, right? Probably once. If it gets up here, I don't know that it sets a new low from here, right? That's interesting, right? Right here, jitterbug zone, then it bounced off of it. I think it gets down to these 2020 prices somehow, but I don't know that. Either way, selling cash secured puts behind the rally, right? Behind the prices, below the prices, when there's weakness, it's just such a great winning strategy. How many of you, ask yourself, how many of you have generated incomes of double digits this year selling just a handful of our cash secured puts? Not even all of them. It's got to be a lot of you, right? I know Shooter's just, Shooter trades them more than I do. Shooter is what we call in poker a grinder. Shooter just grinds it out and grinds it out and grinds it out over here at fundamental trends in this chart room. Basically, this is his trading room. He just keeps adding basis points over and over and over again while I'm out at the pool. But it's what works for him, just like what I do works for me. And whether you're trading a lot or not trading a lot, I would just say respect what could happen, respect the cycles, however they play out. But even up here, you really shouldn't be selling anything that's still within your asset allocation parameters, no matter what. if it's a stock that has big upside in the intermediate and long term. Don't sell potential big winners unless you have to, right? Because it just grew so much that it messes up your asset allocation and could screw up your financial life. Shooter keeps selling puts in that trading room, and then he buys them back in. Sell the put, buy them back in. Sell the put, buy them back in. And he does it outside of what the market's doing. He just picks out different ones each week because every company has its own chart, right? So Scott, how many stocks can you find in a month they have their own unique chart that allow you to do what you're doing? It's got
hundreds if I actually wanted to throw them in there.
Yeah, but you're doing dozens.
Yeah.
So no matter what game you want to play, you can do it. I happen to like the way I do it. If you have a part of your portfolio that you want to trade, and we tell people not to trade more than 20% of your portfolio. For me, it's the cash that I hold, then I sell cash secured puts, but you can trade positions. You just got to understand these big trends. You need to be more in SMID caps, buy the dips on SMID caps, find reasons to sell zombies, and accept that if you have a zombie, that it's a zombie. Because over this cycle that's coming, you'll maybe get some opportunities during the presidential rally, which we almost always get. So in your head, you need to think about, what do I have that's a zombie? What should I ask Kirk about in the chat room? When I own this company, what do you think? And I think you're probably getting a chance to sell a lot of large caps right now, and you might get a second or third chance in the next couple of years. I don't know that, but it could happen. Here's QQQ. Here's Shooter's chart. Here's the potential ending diagonal. And then we saw the one where it goes all the way up to 440. I think the easiest thing would be if it breaks through here, it probably goes to 440. Is that correct, Shooter?
Yep.
So this is a level.
Well, it's probably will overshoot, the speed line. If you draw a speed line from the all-time high down,
okay,
it most likely it's going to overshoot and then will continue lower. But we should have a clear indication there. I mean, RSI should be overbought there significantly. So we should be like 73, 75.
Okay. So if we see this RSI line get up here on the weekly, which is what I always talk about.
Yep.
That's probably where we start to get our turn.
Yeah.
Okay. So that's
now if RSI gets above our prior high in RSI, then that's likely we're going to continue higher.
So then RSI goes way up here.
Yeah. So it should stay divergent from the October 21 high. We should be put in a divergent RSI for the ending diagonal to manifest. And then if we put in a higher high in RSI, we're going to continue higher. That basically is the easy way to divide it.
Right. So the way I've explained this to people in the past is think of relative strength index, which is a momentum indicator, as kind of a giant magnet. If it keeps going up, it's going to keep pulling price up. And if it starts to go down, it'll eventually pull price down. Usually within a week, right? 1 to 2 weeks.
Yes. Yeah.
Yeah. So that is what we're looking for. We'd love to tell you the exact future, but I will tell you this. Anybody who's trying to tell you the exact future right now is just guessing or lying, because the technical indicators are not giving a clear picture right now. And the fundamentals are so wide company to company that you have to literally analyze each one individually. Because the market as a whole, if you call that the Russell 3000, it's probably about fair value. But if you call the market the S&P 500, it's probably overvalued. I think QQQ is probably about fair valued. I wish I would have bought Amazon back when it was 110 instead of being greedy and wait for it to get to 100, which it never got to. We'll talk about some of these stocks on Monday. Shooter, do you have anything incredible to tell us before we go?
I've just answered AA's question in there. What would cause the Qs to drop from 440? A $120.
Yeah. So if the dollar really shoots up.
Yep. Which my counts are up in the 120, 130 range. I have a number of counts up there.
Right.
So that would be the catalyst that would cause that.
Right.
Yeah.
So somebody asked me for a list of stocks that were zombies. I was like, no. You know what's not a zombie is the 200 stocks that I have on the very short list. You know what is a zombie? Probably companies that aren't. at least in the large caps. I can't keep track of 3,000 small caps, right? But we've been picking out small caps that have barriers to entry in competition. That's mainly what I look for. So here, that dollar comment, if the dollar gets way up here, this was right before the .com, right? The .com crash. And back then, Alan Greenspan was pushing interest rates up and the dollar up because he thought there was irrational exuberance, which he was right about. And he took it upon himself to pop that bubble. I am not seeing indications from Powell that he looks at things exactly the same way that Greenspan did. And that's good because Greenspan was kind of a moron. He partied a lot and hung out with the right people and got on TV. But if you read a book about Alan Greenspan, about what he did from a policy standpoint, he was a knucklehead. Powell, while not a highly trained economist, is what I would call a buy-side analyst among economists. What does that mean? He's analyzing the work of the other economists and saying, I think that's right. I think that's wrong. I think that's more likely to be right. I think that's more likely to be wrong. And to me, and remember, I was hypercritical of the appointment. To me, he is proven to be pretty good at it. I think that they didn't overstimulate. I think they did it just about right. I think that the supply side getting cheap financing was important enough that it was okay that demand ran hot. We know that oil is half of inflation. That's not really his problem. We know that there's a record number of housing units hitting the market here through the end of the year. And at some point, unless you're in one of those cities where it just can't be overcome short term, you should be able to find good housing. You might have to move. I'll tell you what, if you move 2 hours out of any major city, there's housing. There is. In Milwaukee, you only have to go an hour.
And David also wanted to see a SPY chart. Do you have one you can throw up? Just go to risk on, risk off right there.
Okay.
Which we're right there. Now that's a 3-way, so we got a back test from there down to that 399. Then we should continue to put it in our 5, which would get us closer to that 440.
Yeah.
So we're at target 1 now. That's from over the weekend. No problem, David.
Yeah. So, if you don't own SPY, what do you do about this? I think the answer is nothing. I don't think it's a big enough potential problem to short it.
Yep.
I think it's too uncertain. When you short, the calendar works against you. When you're long, the calendar works for you. Time in the market versus timing the market. So shorting and betting against things is really hard. And in my career, I have literally only found 3 times in my career where I thought, where I shorted and won. I've tried to short 6 times in my career, and I am 3-1 and 2. That's my record, 3-1 and 2. So I'm a little bit net to the good side, but it's so hard to do that I encourage people not to do it, or I discourage you from doing it, because you have to be so precise, right? So you can find so many analogies. The better thing to do is just wait for the corrections and then suck it up and buy. And I made a mistake down here by not buying enough. I bought a lot of great stuff. I just bought too little of it because of the unknowns of COVID. What if we had gotten a rally off of the Fed and then there was a variant of COVID that started killing a lot more people? We'd have gone straight down. And because it was an unknown, I still kept, 40% of my money in cash. Oh, well.
That was a very hard period, though, I can tell you. I know a lot of people who didn't get a big piece because it was just too chaotic.
Yeah. I mean, it wasn't a typical financial situation. It was an unknown. It was a health thing. How do you bet on what direction the virus is going, right? So here it's different. Pretty much everything out there is known right now. If there's a black swan, and there might be, it's by definition not something that we know. So I think what we know is that the economy is heading in 2 different directions, an old economy and a new economy. The old economy is shrinking, the new economy is growing. That's easy, right? Bet on the growing part. And we also know that oil is short-term and supply-demand imbalance. We're short on supply. But at some point, that's going to flip as demand goes down and panic pumping happens. Probably not for a few years. I said in that article exactly a year ago that it was going to be a couple years before we get the energy thing under control. We're about halfway there. There's certainly potential, and Shooter deals with this over in the trading room. There's certainly potential for a spike in oil. His approach is probably going to try to play it on, make money on that move. My approach will be from the opposite direction. If it spikes, I'll let the calamities happen and then I'll pick up things cheap. So there's 2 ways to play every move. There's actually 4 ways to play every move. That's what that option chart is all about. I just choose to do the ways that give me the greatest margin of safety, least opportunity to lose. Now, I will say, Shooter probably hits more short-term home runs than I freaking have ever seen. But a short-term home run is, 20-30% move. I like to just say, well, I'm going for a 10 bagger over the next decade. and I'll just keep an eye on it to make sure the thesis doesn't change. And when it hits the hockey stick, I'll figure out how to exit. The S curve, the hockey stick, either one. So there's different ways to do things, and it's okay to mix and match. But again, I will use another poker analogy. It is very hard to be both a cash game player in poker and a good tournament player because the strategies are different and it gets hard to do. I am a good cash game player, but I'm becoming a great tournament player. And the tournament players are more like investors, and the cash game players are more like traders. So I would venture a guess, I don't even know if Shooter plays poker, but my guess is that he'd be a pretty good cash game poker player because he'll take a loss every now and then and he'll just go right back to what he was doing because he knows that he makes enough bets, he's in the good. So I think that most people should be the tournament player, limited downside. Every now and then you're going to run hot and win the tournament, right? You're going to have your Peter Lynch stock. For those of you who truly grasp technicals and like studying it and want to play in that sandbox with 10 or 20% of your money, you don't hear me compliment a lot of people. And I'm going to mute Shooter so he doesn't hear this. But he is one of the best I've ever seen at this short-term game. So if you want to add that component, then jump in our trade room, which is going to get even better because I just hired internet marketing and web design company, paid him $8,000 to upgrade my site and advertise it. So if you really want to add that component to your game, come on over. For those of you who want to be more investors, more tournament style players, charts like this, I've been dropping them in here and there where they're appropriate. So it's not like you're not getting it. You're getting it when I think it's worth the time. So, you can stay at margin of safety investing if you're not going to short-term trade. All right, let's call it a day. Tomorrow, I'm going to the Wisconsin State Fair. I hope I don't come back fatter, but the odds are that I will. Yeah, everybody, like I've been telling you, enjoy the summer, put your good till cancel orders in, and try to be greedy. If you did that in May and June, you accumulated some stocks, you spent some of your cash, and you were probably like, God damn it, Kirk, it keeps going down. And then in the last month, I take a look at the chat room and people are like, oh my gosh, I made enough money this month to pay my subscription for 10 years. Well, hey, you know what? Don't cheer too much when it goes up and don't get too sad when it goes down because that's just the nature of the beast. Buy the dips and especially buy the big dips. And if your asset allocation gets out of whack, that's about the only time to sell anything that we own. And I'll let you know when it's time. All right. Have a great day, everybody. Thank you very much.
Have a great
Shooter.
one, folks.
Yeah, thanks, Shooter.
Thanks for having me.